Hey gang, Steven Sitkowski here. Welcome to this week's edition of Market Insights. Take a look at what's moving the market, among other things. So why don't we get to it? It is November the 6th. Hope all is well with you and yours. Want you to know that everything that we do here is for educational purposes only. Not intended as investment advice. These are just some of my personal thoughts based on 40 plus years of experience. When you think about the market and creating and building a portfolio, some of the considerations that ought to be top of mind. And what are the fundamental influences that are now driving the market? We're going to talk about that. What is the overall market condition and sentiment? Got you covered there. Look at the various sectors that are both moving up and moving down at any point in time. And then finally, stock selection. So let's get to it. What's moving the markets? Well, they enjoyed a very good week last week. Markets were up 6-7%. It was an incredible reversal. We've had a tough August, a horrible September. October, slightly better, fairly volatile. And by the way, all those things, pretty normal. It's what we call seasonality. And speaking of seasonality, if you go back and look historically, we're moving into a time when markets generally go up November, December, and January. I think there's going to be a whole lot of money to be made in the next quarter if you know what you're doing, and especially if you know how to leverage your investment dollar. Fed may be turning dovish. Maybe interest rates are done going up. That's at least the probability as of right now and the outlook. So not only did the Fed on November 1st not raise rates, but just the general tone that came from Chairman Jerome Powell, it seemed to be laced with the thought that he'd really like to hold rates where they are. And I suspect there's probably a 50-50 chance that he's going to be able to do that. Interest rates fall across all maturities, the 2-year, the 10-year treasuries. Those rates have both come down. The 10-year came down to 4.635%. It had crossed above just a couple of weeks ago, 5%. And it freaked the market out, and the market took a big drop. So as these treasuries began to ebb, we saw the market go up, fairly predictable. And oil's been steady in the low 80s here for a while. What are we watching this week? It's a slow news week. Today, the Fed Governor Cook will be doing a speech. On Tuesday, a little bit of Fed speak. Consumer credit, typically not a market mover. Wednesday, Jerome Powell delivers some opening remarks. That could be significant. We'll see. Thursday, we have our initial jobless claims. And again, Jerome Powell is on the panel for the IMF. And then consumer sentiment, the preliminary number comes out Friday, November the 10th. So a fairly light week news-wise, but some things that are significant. Last week's heat map, man, this was a Rembrandt, about as good as it can get. Look at all the green. NVIDIA jumped 10% on the week. Tesla, 12%. Meta, 5%. Yeah, it was just great. Year-to-date heat map, very bifurcated. You can kind of slice across here, and you've got the companies that have done exceedingly well, and you have a lot of stocks that, in fact, have lost money. But Meta up 164%, NVIDIA 211%, Tesla almost 80%, Amazon 67%. The biggies, Microsoft, Apple, both doing great. Lilly, been a very good performer this year, up 60%. but it hadn't been a walk in the park. Look at all the stocks that are red. So it's all about knowing what you're doing, which is kind of how life works, isn't it? Market breadth. Last week, if you look at advancers versus decliners, it was almost a joke. 2,665 stocks moving higher, 347 moving lower, new highs and new lows. That still is not great. 122 stocks hit new highs on the New York Stock Exchange. 424 new lows. We're not out of the woods yet. And look at on the NASDAQ, 122 versus 858. So you got to keep an eye on that noise. Seasonality, the Santa Claus rally. Well, if this proves out, we could see the market go up to 4,800. That is not a prediction on my part, but it goes back to 1950. So generally, like I said, November, December, January, very good months. Stocks trading above their 200-day moving average. Look at that huge jump. And we need stocks above their 200-day. Below that, it's fair to call them bearish. The VIX, which is the volatility index on the S&P 500, collapsed under 15. It had gotten well above 20. So this lets us know that the market is calming down. The VIX is priced and established based on what people are willing to pay for put options on the S&P. Earnings surprises, consumer discretionary led the way. The only two decliners were healthcare, barely, and energy. Guidance has been weak. So earnings have been relatively good throughout the season. Guidance, not so much. So basically, during these earnings calls, the guidance comes from whoever the presenter is, the CFO, CEO, talking about what they expect to see down the road. Earnings are expected to rise for the next 3 quarters. But we got the second quarter, we had contraction. And now we're starting to expect expansion. So that'll be great throughout the end of next year. Labor market is weakening, which is good in terms of the Fed. The Fed wants to break labor. They need unemployment to go up a bit more. It's up now, I think, to 3.9%. They'd like to see it go above 4%. They'll never say it, but they do. They want to see unemployment go up, and they want to see wages come down. Well, they're getting one of them. Look at what's happening with unit labor costs. They were down 0.8% last month. Investor sentiment is still bearish, which is really interesting. We have all of these green lights around us, and yet 50% of independent investors are expecting the market to fall over the next 6 months. Only 25% expected to go higher, which is very strange to me. Big question, is the Fed done? So this is the CME FedWatch tool. 95.2% probability right now that there is no rate increase, not the December, January, or March meeting, and they're expecting a rate cut in May. And there are some that are saying it'll be 50 basis points. That would cause this market to skyrocket. I don't see it happening, but this is fluid. We'll keep following it week by week. And we've got a number of earnings announcements coming out. Most all the big companies that we follow, they have already announced, but some of these smaller companies, they can make a dent in the direction of the market. So you're going to want to be paying attention both to the earnings as well as their guidance. All right, let's take a look at the chart, see what we got cooking. We'll go to the SPX, which is the S&P 500. And looky here, we have crossed above our 50-day moving average. That is a huge win. That is a huge win. We need to stay there, and can we break above this level? So time will tell. So far, so good. Wasn't long ago we were down below our 200 days, so it made a rebound very quickly. And I think most of that is interest rate driven on the Qs. So here's big tech. We are above our 50 days. So for right now, things are feeling pretty good. Interest rates down, seasonality in our favor, earnings moving up. You know how this market goes, my friends. It is week to week. So I'll be back with you next week, give you another update. Until then, stay blessed and bye for now.